We're going to be sharing a bit about fundraising, some of the latest developments in fundraising. We're going to be thinking about some of, particularly from a legal and governance perspective, some of the developments there. One thing that a really popular question for last time was just a bit of clarity on the difference between CICs, community interest companies, and CIOs, charitable incorporated organizations. Believe it or not, they're different. In fact, they're very different. So we're going to be going through that a bit today. Jonathan is going to be sharing his experience of leading a charity during a time of uncertainty. And then also we're going to look at some key charity accounting reporting issues. What are the most common sort of pitfalls that we come across? What are the most common issues that we come across as we work with hundreds of charities in helping to prepare their accounts? We're going to go through some of those. We're going to share a bit with you some of the ways in which we can support the charities in a wider way. And then there'll be a chance for Q&A. So do be storing those up and to just sort of think about what you'd like to ask as we come to that section of our session. But first of all, what I'm going to do is hand over to Cecile, who's going to share with us first of all.
Thank you very much, Ed. Good morning, everybody. How very nice to see you, whether I can literally see you on screen or not. Lovely to be with you. So we're going to start by looking at some fundraising areas. First of all, because many of you are trustees, or if you're not trustees, you work with trustees, I thought I'd mention the focus for trustees. Research undertaken last year by the Charity Commission broadly indicated that the main focus of trustees and the greatest amount of the time that they spend is on ensuring that they themselves, the charity's staff and any of its volunteers pursue the best interests of the charity, particularly, of course, the best interests of its purposes, knowing what the charity is set up to achieve and the difference it makes. But running that a very close second was trustees having to spend time and dedicating a lot of effort to ensuring the charity has sufficient resources. And that's because of the usual challenges of fundraising and funding pressures, but also because of the events of the past year plus, which have very much added to that. So trustees are focusing a lot of time on the charity's funds and on fundraising for it. The second area I thought I'd touch on is online fundraising and crowdfunding. Now, these have grown very significantly over the past couple of years, and they have accelerated apace during the pandemic. But I'm afraid it's not necessarily all good news. Some of the fundraising platforms that are well known, some will spring into your mind, no doubt, when I say that, are, for example, promoting crowdfunding very heavily. One extremely well-known one is doing so. And remember, there's a lot of variety to this. Online fundraising, for example, can include emails and pop-up banners, as well as websites, platforms, and a host of other different ways that these things can be done, in a sense, online. Now, all this can be very useful as tools for charities in their fundraising, but there's a range of concerns about the largely unregulated nature of these activities. Much of it is either beneath the radar of the regulations and the law, or the law and regulations have not kept pace with the developments that have happened and the ways in which people are using these things. Particular concerns are around individuals and groups informally fundraising for non-specific charitable causes, or for particular charitable causes or even named charities, perhaps in ways that are not appropriate. Charities have concerns and are expressing them, and there have been some public complaints to the fundraising regulator about allegedly misleading information. Just one recent case, which involved two individuals raising over £200,000 through online fundraising platforms, supposedly to help Rohingya refugees. The funds went into bank accounts and a PayPal account. About £70,000 disappeared. Eventually, the Charity Commission managed to recover about £196,000 and get that to genuine charities. But this took well over 2 years from the Charity Commission becoming aware of the issues, and went on a lot longer in total, and cost a lot of public money. And although those individuals are now banned from any proper role in a charity management or trusteeship, the stable door, as it were, was rather shut after said horse had bolted. Why do I mention it? Well, partly to say there is a need for some caution and care, including as a donor, but the fundraising regulator is now in conversation with the Department for Culture, Media and Sport, which has responsibility for charities, about this regulatory gap in these areas of activity for fundraising. It's not part of the fundraising regulator's remit when it's done by individuals and groups, and the fundraising regulator says it doesn't have capacity to take on a wider brief. The Code of Fundraising Practice, hopefully you know that this is a mix of information on legal requirements and best practice. It's possible that there may be some further adjustments to the best practice guidance, particularly around the concerns about online and crowdfunding. The fundraising badge, this is what charities that are voluntarily registered with the fundraising regulator can use. That's being reviewed this year as to how it's being used by charities. The regulator will be asking charities about how they're making use of it. The fundraising preference service, this is the mechanism which allows individuals to suppress ways that charities contact them about fundraising. Again, ongoing concerns about that. They include the fact that the usage is extremely low, dropped by 37% last year on the prior year. It was already very low. The pandemic may have had some impact on that, and it's extremely complex and expensive, essentially, for a tiny number of users. The fundraising regulators admitted it was designed for a worst case scenario that simply never happened, and that it needs rationalisation. It's taken some cost-cutting steps. For example, it's brought the call centre agency arrangement to an end and brought the calls back in-house, but it's looking at further cost savings. But it's also looking at more publicity for the service. Charities have got problems with it, for example, because if you're asked to not contact somebody by certain methods, but you don't know who they are, you've never had contact with them, you won't have data protection permissions, and you may not have forms of contact consent to actually get in touch with them. So there are some issues around the whole arrangement. Charity Commission perspective on fundraising. Well, they recognise how vital it is and what pressure trustees are under, but they continue to emphasise the need for trustees to have a key role in setting the overall approach to fundraising, making sure that is followed in practice, and making sure that what the charity does in fundraising reflects the charity's values. The now gone chair was extremely focused on public opinion in these and many other matters, what was perceived as public expectations. That chair has now left the commission, and there's an interim chair in place until August. So we'll see whether there's a change of wind, if I may put it that way, at all, eventually when a new chair comes in. Reporting fundraising, this is an area where there's room for some improvement, both as to the Charity Commission surveys have shown this. They tend to only look at large charities, and their indication on these quite small sample surveys is that fundraising reporting is not being done well or even correctly. But also other people have looked at independent checking of fundraising reporting in a range of charities and found that there really isn't good transparency, and in some cases there isn't legal compliance. So all of that is up for some improvement, shall we say. Fundraising as the lockdown eases, the fundraising regulator is in discussion with central government about how it might update the joint guidance with the Chartered Institute of Fundraising. Recognises charities are keen to restart or adjust activities. It says it's not going to be prescriptive, which is a great relief, and that organisations must continue to make their own reasoned and informed decisions. Thank you, Ed. We'll change slides. Take questions on fundraising in the question sessions. There's more to be said. So, quick skate through the differences between CIOs and CICs. A CIO is a special legal entity that can only ever be used as a charity for charitable purposes. It is a charity, must remain a charity always. Created when it's registered with the Charity Commission, has to deliver charitable purposes and public benefit from that, and its purposes, like all charities, are fixed and it must stay within them. They're set out in the Constitution. The funds and assets of the CIO are protected for the charitable purposes by charity law, just as charitable funds and assets will be in any other charity, and it has to act for the right beneficiary group. But on top of all of that, there's quite a lot of very specific CIO rules. Legal rules are definitely only for CIOs, not for other types of charities. A whole host of them, and our time today doesn't allow to go through them. Contents of the Constitution, rules on members' duties, members having a duty to use their rights in a way they decide would be most likely to further the CIO's purposes, and frankly, a whole lot more. Some of the requirements are petty, some are very important. And it has no exemptions for filing with the Charity Commission. We find this catches people out all the time. Must file a charity annual return, must file annual accounts and a trustee's annual report, regardless of size or activity, even if there is no activity. Ed, thank you. Do move us on one. Thank you. So how does all that contrast quickly with a CIC? Well, a CIC is a special type of company that exists for community benefit, not shareholder or investor profits. It's subject to additional legal and regulatory requirements beyond those for ordinary companies. It absolutely cannot be a charity. Can't stress that strongly enough. We've seen people get in a terrible mess where perhaps they got confused, didn't take advice, and ended up with entirely the wrong legal vehicle that then simply couldn't be a charity, couldn't register with the Commission. The law bars a CIC from having charitable purposes. Must have community interest purposes, so it has restricted objects that are for the benefit of the community, and its activities must be directed to that community benefit. Its directors have obligations in that regard, and they must, amongst other things, report publicly about their delivery on that. There's more complex annual and accounting reporting to Companies House and the CIC regulator than there will be for a standard company, additional disclosures, for example. The annual community interest report is a very important feature of that, but not the only feature of those different aspects of CIC reporting. Really what CICs have is a feel of the broader impact economy, where triple bottom line is the focus, not pure owner profit. So the good of society, the care of the environment, as well as the positive outcomes for society, including financial ones sometimes. Typically it carries on business services, typically it charges for its goods or services, but all of that is to the community benefit. And its asset lock means that its funds and assets must be used for the community benefit purposes. There are restrictions on the level of remuneration to its directors, for example, if they are paid. Actually, most of them are volunteers, and controls on the level of rewards investors can receive in the case of either loan funding or in the very relatively small number of share limited CICs. That asset lock extends to being required to, if they sell their assets, they must sell them for full market value, pull the money back into the CIC and redeploy it to the community activities, or in some cases give it to the community. And in the winding up of them, the funding would, any final funding would have to go to a similarly asset locked body, like another CIC or perhaps a charity, but for the same community benefit purposes. And all of that has to be reflected in their constitution as well as the way in which they operate. So it's a very different beast, and it's not a charity. Ed, thank you.
Thank you so much, Cecile. That's really, really helpful. There's already a few questions coming in, which is great, but do keep them coming, and we'll take a chance to answer some of those later on. It's a pleasure to have Jonathan Lee with us from In Hope. Jonathan is Chief Executive in Hope Bristol, a fantastic charity, very inspiring charity. But I've had the pleasure of working with Jonathan in many kind of different capacities over a number of years now. And Jonathan is an excellent leader. And so it's a real privilege for us to have his insights and his experiences today. So Jonathan, over to you.
Sorry about that, everybody. My mouse decided to misbehave just as I was trying to unmute. Let me share my screen. So thank you, Ed, for that very kind introduction. It's a pleasure to be with you all this afternoon. As Ed has said, I'm Chief Exec of In Hope. We're Bristol based and we've been here for over 35 years, providing food, shelter and hope to those who are most in need. We're motivated by our Christian faith, and our watchword is acceptance, seeking to accept whoever comes to us. And through meeting their practical needs, we build trusting relationships which go on for many, many years. Over time, we see people being able to move on in their lives and begin to live life to the full. And one of those, the presentation is not moving on. There we go. So, yeah, how do we do this? We provide food and practical help. We engage with people through listening, through accompanying them on their journey. We provide shelter for women, particularly in an environment that is safe, that is, enables them to build self-confidence. We teach life skills. We support people to live well in their recovery from addiction. And we're working towards being able to access long-term move-on housing for the major need for many of our clients. We've recently launched a program called Homes Not Houses, through which we're doing that. And in the future, helping people to develop their readiness towards employment. And we do this through our kind of primary projects. Some of these may well be familiar to some of you. The Wild Goose, which is our drop-in for homeless, Spring of Hope, which is our women's project area, Life Recovery, which is about, as I say, supporting people in their journey of recovery. And through working locally with many different partners and equally nationally as well. So thinking about this this question of leading through uncertain times, I think many of us have been in this situation over the past, what is now 12 months. And I thought I'd kind of convey this by giving a little bit of a timeline for us as a charity. What were we doing at the beginning of March last year? Well, it was life as normal. Weekly management meetings, weekly get together with the staff, which we do every Tuesday morning. Beginning of March, we have a board meeting. It was the normal regime for the March board meeting, which is, here's the budget, will you review it and approve it? But at that time, we also were beginning a major refurbishment of our primary building. So we were getting ready, we were moving out of our building, moving the Wild Goose activities into the church, which we are connected to next door, and setting up temporary office spaces for staff, and all of it goes on with moving furniture, clearing out the rubbish of 10 years in a building, setting up the IT and telephones, and all of that practical stuff was all going on. And yet at that time, we'd put together our risk assessment around this thing called coronavirus. We'd done some thinking, what does it mean? What might it mean? So we had that in place, and like many others, we were starting to source PPE, masks, gloves, sanitizer, so that we whilst we didn't know what we were facing, we could continue to operate in appropriate ways. And by March the 23rd, that infamous evening when, as probably like many of you, I was sat in front of the television watching the Prime Minister's briefing and the announcement that we were heading into a lockdown. I don't know what you did that evening, but I went upstairs, opened the laptop and started writing letters so that our staff had something in their hand that said they were a key worker, so that they could move around with that confidence without being stopped and questioned. Why are you travelling here, sir, at this time? You should be at home. Our risk assessment turned into an operational plan. Right, what are we going to do? How are we going to operate? You know, with the refurbishment and moving out of the building, we were already well placed to just readjust what we were doing. We put in additional conversations, additional meetings. We were no longer in one building together. We were more dispersed. We put in additional staff meetings on a Friday, so that we were not only collecting, you know, in our normal ways, we were adding more opportunities to connect over this thing called Zoom, which we now kind of, it's normal, isn't it? It wasn't, but now it is. Management meetings went to being twice weekly instead of weekly. There was so much information to kind of assimilate and work through. I was putting together a weekly briefing based on those conversations with the team and with management. I would send that on to the board, to the trustees, and it wasn't before long that we had twice weekly catch-up with the board. They were making themselves available for an hour, twice a week, just to say what's happening, because things were really moving fast. I can tell you, they were so, not only with what was happening for us, but also what was happening in terms of guidance, the amount of guidance that was being issued out through central government, but also we were looking towards the Ministry for Homes, Communities and Local Government and the Rough Sleeping Initiative, and looking at the guidance that they were sending out as well. I tell you, my head went into a spin with the amount of information that we were having to assimilate and put into practice. And alongside that, we just handed our building over to a contractor who turned up on the 24th of March with his guys and their tools and set about refurbishing our building. So not only did we have a health and safety assessment on the refurbishment work, but health and safety reassessment in the context of social distancing and masks and all of that stuff. But work started, which was great. And moving on, we couldn't not think about our supporters. We shifted our monthly e-bulletins to being weekly so that they were aware of what was going on. And we our fundraising manager came across this model for fundraising in times of crisis. And it just helped us think about, right, okay, what could happen? What are the scenarios that may impact us financially as a charity? That said, over the past 12 months, our income has gone through, not quite gone through the roof, but it's been phenomenal. Yes, there's been peaks and drops, but we have broken our monthly income ceilings several times. Last financial year was our first year as a charity needing an audit by Ed's team. We reached the £1 million mark, but primarily that was because we benefit from over £300,000 worth of gifts in kind. This year we will go beyond £1 million purely in terms of and our budget for next year is over £1 million. So we've grown. There's been a lot of access to crisis management grant funding. Some of that is about operational, but equally some of that has been about restoring reserves that charities have had to draw upon. And I think it was probably the summer last year, I think we all probably relaxed back into some more normal patterns. Of course, we were still socially distancing, but our communications, our way of working together as a team did relax back. And we worked towards, that progressive reinstatement. And also thinking about what was changing for our clients, our beneficiaries, what was going on. And we came up with a question. And the question that we began to ask ourselves as a charity was, well, as the UK comes out of the coronavirus lockdown, and as we've seen, local outbreaks continue, how does In Hope work towards progressive reinstatement? Sorry, does In Hope work towards progressive reinstatement of what it used to do? Or do we adapt to what has changed, what's changing, and what the needs of our clients are? And we created out of that an evolution document that has shaped the way that we are now thinking about our work. We cannot go back to what we were doing more than 12 months ago, because the world has changed, and what's changed for our beneficiaries needs to be recognised. So we're evolving, and that's exciting. Our refurbishment was continuing, more slowly, certainly, but we came through it. We got the building back at the end of last year. We're now using our refurbishment building, but a lot of us are still working from home, like me. And then this year, I think, we've probably reinstated some of the ways that we were working before. The conversations that we have in management teams now and with our board are not so much about crisis management. We're no longer adapting to changing needs, although they're still changing. We are thinking about, right, what are some of the basics of how we operate as a charity? Our operational work, our work on policies and procedures, but equally our work on some of our charitable development targets, our evolution, having those conversations. Over that time, we co-opted new trustees. We needed to. We got a bit low on numbers, but we've managed to co-opt new trustees. We've done some senior recruitment as well. I did, middle of last year, we were doing screening interviews, 8 candidates in half-hour Zoom meetings. But we were then able to do some socially distanced face-to-face interviews into a senior management role. That was necessary. We needed to still recruit despite all the issues that were going on around it. I think, it's all been about maintaining connection with each other. It's been it's hard, it has been hard, and it continues to be hard. We continue to be braced for the impacts of this pandemic. We run a food bank whose output has doubled already this year, and it's not yet the end of the year. We know that things that impact our beneficiary groups are yet to be realised, and we still don't know what that's going to look like. So we're braced for those. We're actively pursuing our charitable objectives and our aspirations for development, housing I've mentioned. But we're tired. I think that's an the team are tired, but ready to serve the needs of the beneficiaries that we have. So hopefully that's been helpful. It's a little bit of a snapshot. You may well resonate with some of it. But that's been our journey, and hopefully we move out beyond uncertain times. Thank you very much.
Thank you so much, Jonathan. That was very, very helpful indeed. I'm sure many of us really sort of recognise some of those processes and recognise the challenges, and I think probably identify, if you're feeling and looking tired as a charity leader, then I think we all kind of know why that is, just listening back to some of that processing. And of course, for many of us, we're still in the middle of that and just sort of pivoting into this year and knowing what's going forward. We're going to spend a few minutes thinking about some accounting and reporting topics. So if you're here as an accountant and as a techie person, this is the bit where, this is a little treat for you, really, just for this. So Josh and I are going to do a bit of a double act on on this, just to sort of take you through a few sort of key topics. And inevitably, we're not going to be able to kind of go through into lots and lots of detail through every point. But what we'd love to do is just highlight what we think is perhaps some of the key implementation issues and the common pitfalls around charity accounting and reporting. And so I'm just going to share some slides with you again. And I think what's interesting is that there's a real agenda at the moment around how do we sort of free up some of the bureaucracy around charity accounting and reporting, particularly for very, very small charities. The requirements, as a lot of us will know, are actually, it's quite a high bar to get to be able to have good, transparent reporting. And actually, of course, it's a really positive thing. It's good that in England and Wales, we probably have the most advanced charity regime in the world. And so that's great. But with that probably comes some complexity. We're going to talk a little bit about some of those complexities, but there is an agenda as we look ahead to the next SORP, which will be Statement of Recommended Practice, which won't be now until at least 2024-25. Those changes will come in, but there is a lot of work being done to say how do we make sure this is appropriate, because as we look at the charities register in England and Wales, so this is just the registered charities in England and Wales. There are a whole load of charities that are actually not on the register at all. But actually the picture that we see here, and this is the Charity Commission's own data, is that the vast majority of charities in England and Wales are actually very, very small. So of those on the register, 90% of charities in England and Wales on the register have income below £250,000. And yet that 90% of charities represent just 6% of the total income in the sector of those on the register. And so what we see is that actually overwhelmingly, the vast majority of charitable resources are really in the hands of the very, very largest of charities. And so this is the kind of the framework and the context that needs to drive charity accounting reporting and its complexity. I'm sure many of you are looking at that and thinking, gosh, we're a bit bigger than we thought we were first. But that's really sort of the context that there is there. The first thing I guess I want to say about charity accounting reporting, that there are some technical things to cover, and there are some important technical things about preparing a set of accounts. And yet fundamentally what it comes down to is this: does the accounts that we are preparing, do they tell the story well of the charity? And I'm going to say something very controversial as an accountant, and that is that the numbers themselves actually are not sufficient to be able to do that. The trustees report is absolutely vital and fundamental to conveying the story. And that story is not just a story of highlights, it's a fair and balanced review of what's gone on. So particularly in the midst of COVID-19, we need to tell our stories well in terms of what has happened, in terms of the impact on the charity, the impact on our finance, the impact on our future plans, the impact on our ability to deliver on our charitable purposes. So just encourage you to tell the story, Josh.
Thanks. We love that concept, don't we? Tell the story. And now here's another one. The trustees report is live until you've signed it, which means that you need to keep telling the story. So right up until you sign a trustees report, the story is still live, if you like. So if there's anything like trustee changes, anything sort of complicated on your constitution or something that might have changed from the year end right up until the signing date, you still need to include those bits and pieces. One quick example would be 31st of March 2020. A lot of charities or trustee boards might not have been thinking about including anything about the pandemic because it's only just happened right up near the end of the year. But actually, we were signing it in June, and there's actually been a lot of change, as we just heard from Jonathan, about what's been going on in regard to the pandemic that would be really good to communicate to users. So quick example, but keep it live until signing. Keep telling the story, Ed.
And another key area that we're finding people get quite confused at is reserves policies and their disclosure in the trustees annual report. We find that people either go down this route. They say, yep, our reserves policy is, we're going to explain what we need. We're going to explain our target level of reserves. But then they don't go on to say how that compares with what they actually have. And then a whole load of other charities will say, these are the reserves we've got, full stop, without making any comment at all on actually what their needs are. Really, what's required is both of those things. You need to explain by having done your risk management through thinking about your future plans and opportunities, what is the level of reserves, free reserves that we need for this charity? But then to do the second step and say, this is what we actually have. This is our actual level of free reserves. Compare those two amounts and explain any variance between them. It's really important.
Could you just take us to where all the funds are, because it will help me explain this bit. So free reserves, that free reserves is what we're aiming with, and we love a calculation, so I'll talk you through that. Free reserves are what the trustees are able to spend freely. That's the sort of the concept that we're aiming for. So what we want to have in that sort of policy note is a calculation which starts at the top. What we're looking at here, the total funds of the charity, all of this. If we can start there, and what we're going to do is take everything away until we get to the free reserves. So total funds at the top. We're then going to start on the left, take away endowment funds. We're going to take away restricted funds, telling the users what these things are as we're taking them away. We're going to take away designated funds, and you might go, oh, that's interesting. We take away things that we as trustees are deciding on. I'll take that away as well. And then we also take away something. So we're left with general funds at that point. And then we can take away something else as well. We can take away items that we might otherwise have committed. And a good example of that is tangible fixed assets, which sometimes, and we quite encourage charities as Burton Suite to do this, we ask you to designate those, because something that you can't really do as a charity is spend your tangible fixed assets, which is why we think designating them is a good idea, but they're also out of free reserves anyway, because you can't really spend a building unless you sell it. And often as a charity, if you're selling your building, you then can't use it for your beneficiaries. So not very easy to spend. So your free reserves, take away endowment, restricted, designated, and your fixed assets, and what you're left with are your free reserves. There are some nuances in there. I've made that quite black and white, but that's a sort of a nice way of getting down to your free reserves. And what's great also in your trustees report is if you communicate that really clearly. So that's your calculation.
Great. If you are a charity that has income over £1 million income, that you are required to include some disclosures about your fundraising practices in your trustees annual report. And there's a list where you go through to be able to sort of figure out what we need to include. But it includes things like, what's our approach to fundraising? How do we, how many complaints have we had about fundraising during the year? What fundraising bodies are we a member of? If you are a charity that has income above £500,000, then you need to include some enhanced risk management disclosures, which effectively means, what is your approach to risk, but also what are the principal risks that you face as a charity, and what are you doing about as you face those risks? And designed to be really specific. Don't go for kind of bland statements. Go for actually, in our charity's context, what are the key risks that we face? And if you're a charity below those income thresholds, do it anyway. It's best practice. It's a good thing to do, but it's required for the fundraising over £1 million income, for the risk management over £500,000 income. So that's the trustees report. There's a few points on the accounts. If you ever seen two accountants have more fun talking about accounting than we are at the moment, we'll smile.
It's great. Rapid fire. Here we go. So basis of preparation. This is really, really, really crucial to get right. So I'm going to start with, so it's accruals or receipts and payments. So I'm going to start with receipts and payments. Now this is only available to a select few. So you might have thought, I didn't know that there was a choice here, but a few charities can do this. If you are an unincorporated charity, or if you are a CIO, which we've just heard about from Cecile, and if your income is below £250,000, then you have a choice. It's not, you don't have to do it this way, but there's a choice to prepare your accounts under receipts and payments basis. Now that means that you just record cash in, cash out. And then there's another little disclosure, which is what assets, liabilities you have and what funds you have. And usually that disclosure is two pages, one in sort of your cash in, cash out, and the other is your assets sort of sheet as well. And that's all the accounts or the numbers bit that you've got to do. And then you've got your trustees report, which tells the story. So much reduced disclosure if you're doing receipts and payments. But for that size of charity, it's appropriate and good. So you don't need everything else. But what you can't do is mix and match. You can't do a bit of receipts and payments, but we'll chuck in depreciation because we like to calculate that. And we can't do a bit of invoicing bits and pieces because we like that, or accrue something. It's got to be cash basis or accruals basis, which is the basis that perhaps many of you are a bit more familiar with. And If you're anything else other than what I've said in the criteria, then you have to do it this way. If you're an incorporated charity, for example, you have to go this way. And accruals basis is full SORP. There isn't a halfway house, it's full SORP at this point. So you've got to have your SOFA balance sheet, maybe a cash flow statement if you're large enough, accounting policies, notes up to the accounts, and it's got to be accruals. So we're not thinking about cash, we're thinking about whether you're owed money or you owe people money. There's accruals, there's prepayments, there's depreciation, all of these good things. It's more involved, but it also is standardized, and the SORP helps us tell perhaps a better story with the trustees report about what's going on in those larger charities. So that's your basis.
Wonderful. If you prepare accounts under the SORP, accruals accounts under the SORP, then usually the basis on which those accounts are prepared is that the charity will continue as a going concern for the foreseeable future. It will continue in operation for the foreseeable future. And that's effectively what you're doing as trustees as you sign off the accounts, is saying, that's the basis on which they are prepared. It's important that you, in your accounts, you explain and justify that position. Now, it used to be that you explained and justified it if actually there were sort of concerns and there were obvious things that you need to comment on. Actually, now you should explain and justify it whether or not there are actually any concerns or not. Now, of course, the reality is that every single charity in the current global environment should be thinking about going concern. For some more than others, but everybody should be explaining and justifying why they're preparing accounts on a going concern basis. In other words, that assumption that the charity will continue into the foreseeable future.
Again, income recognition is on the SORP side, and I'll start with legacies here. So a lot of charities may be thinking that they recognize legacy income on a cash basis when I get it, but actually there's three criteria that we need to think about when you reflect legacy income, and I'm just going to focus on you actually really think about legacy income when you know about it and when it's measurable. So usually you get something like a letter from a solicitor who tells you, congratulations, you've got some legacy income coming to the charity, and this is roughly how much it might be. And that's when you recognize it as income. It might be that you get it a year or two down the line if it's a complicated estate, but that's the key point with legacies. They want you to recognize it when you know about it. And then we've got grants versus contract income, pretty tricky area. So grants are effectively part of donation income, but a donation from a sort of organization or a corporate body perhaps. And what that is a donation to you, to do a sort of a gift to you towards your work. So I really like what you're doing over here. I'm going to give you a donation for the whole charitable activity. Or I really like that project specifically. I'm going to give you a donation towards your activities there. There might be some little hooks coming back. I'd really like to know some information about it before I give you another gift for the next part of the gift. But it's still a gift towards it. It's not something else. So that what I've described there a little bit is some restricted grant income if it's for a specific project, not the whole charity. And it might be that the timing of when you reflect that is interesting, because grant income tends to be reflected up front because it's a gift. It's not over the length of the project that they might be giving that gift towards, which is why we need to separate it from contract income. Contract income is about a service contract. So I'm going to pay you to do a service for me, and that income is reflected over the length of the service, which is why it's important to do it differently to a grant, which is usually on day one. And often organizations giving that contract or grant to you aren't necessarily clear about whether they're giving you a grant or a contract, and you may be a little confused. So it's really, really important to get those things right as you take on that income yourself.
It's such a complicated area, and certainly something to really think through, particularly in this environment now where so many grants are dressed up as contracts. They're dressed up in sort of contractual wording, and it can be really challenging to know which is which. We've already mentioned fund accounting and shown you that diagram, but I think we find in practice that there can be quite a lot of confusion around people's funds. I just want to encourage you, if you're involved in charity accounting reporting, to be really clear on the funds that you hold. In particular, there's a lot of confusion quite often between restricted income funds and designated funds. Restricted income funds, they are legally restricted. In other words, a donor has come to you and said, here is a donation, you must use it for this. Or perhaps you've gone out there and you said you've put out an appeal and you've said, we'd like to raise money for this particular aspect of our work, please give towards that aspect. You are creating there a legal restriction by doing it. A designated fund, on the other hand, is where you have money that is freely available to the charity. It's unrestricted funds, but you make a choice as charity trustees to set it aside for a particular purpose. You put it in a jar and you put it on the shelf, and it's for a particular identifiable project or future purpose. And you can take it off the shelf at any point you want and dig into it for other purposes. And getting that distinction right is really important, because it really helps decide what fund you have available. I think very commonly things that we see are people trying to designate funds when they don't have any funds to designate, where they haven't got enough. They try to designate £100,000 when actually their total unrestricted funds are only £50,000. You can't put a negative something in a jar on a shelf. So things like that are quite common. Understanding what endowment funds are really important too. Endowment funds are capital funds that are used in the long-term work of the charity, either because they're restricted for that purpose, that there's a permanent endowment, there's a legal need to keep that capital permanently to use in the charity, or perhaps it's an expendable endowment, which is a whole other conversation, which we'll perhaps leave for another time.
Thanks. So we've got the carrying value of properties there. So there are two types of property. I'm going to start with investment properties. And they always must be carried at valuation. So when you value a investment property, the important thing is to get the policy right. So to keep an investment property at market value, it's really good to just set your policy to say, we're going to value it every 3 years, 5 years, and then depreciate it in the meantime. And then what you need to do is to look for indicators of impairment as a trustee board in the intermediate years. If due to market sort of pressures, the value of a property might rise in the intermediate time, we sort of don't mind too much about that, because the valuation policy will keep us in line with market value, because the next time we get to the next 3-year or 5-year step, it will bring it back in line again, and we don't sort of have to do it every year or anything like that. When we think about charitable property, which is different to the investment properties, you have a choice at that point. You can either do it based on valuation, which is what I've just described, or you can have it at cost, less depreciation. So it's as it sounds, you bring it into the accounts at cost, less depreciation over the years. And at the same time, you've again got to be looking for indicators of impairment every year, just to make sure that something significant hasn't impacted the value that you're holding it at. Then you should be reflecting it at a lower value. But occasionally you might have that depreciation each year set at 0 depreciation each year, in which case the annual impairment review is extra important. You've got to justify why it might be 0, and we hope to see those policies rarely, generally speaking.
Thanks so much, Josh. We're going to leave those last two, and instead we're going to send you some notes about those with the slides. But donated goods and facilities, often a bit of a sticky area, and also related party transactions. If there are any areas of debate within the office, quite often they're around related party transactions and what's needed or not. So, there are some sort of key areas to look at. Probably a bit dazzling for some of us, quite entertaining for others. But in the last few minutes, we're going to invite you to submit some questions, and we're going to answer as many of those as we can. But just as you have a little think to yourself about perhaps some things you'd like to ask in a few minutes, I'd just like to hand over to Cecile. I'd like to ask Cecile, it's probably quite obvious to many people here that we get involved in charity accounts, and we do audits, we do independent examinations, we're involved on the finance side. But we actually offer a whole wider range of support to charities. And I just want to ask Cecile for a minute to talk about her role and the ways in which she can support charities.
Thank you, Ed. Yes, my role is about helping you through the law and the regulation. So that would be everything from your constitution to your governance to the legal form that you're in. What type of charity is it a CIO? Is it some other legal form? So I help people that at the beginning of their cycle, new startups. I help people who are established and facing challenges, needing to grow, needing to shrink, people who want to change, perhaps to update. So for example, bring their constitution into the modern age, give their trustees some training, give some guidance to their senior management team. So essentially anything around law, regulation of charities, and indeed the wider civil society sector. So things like impact economy organisations, things like community interest companies. And I can do it for Burton Suite existing accounting clients, but also I'm quite often working for an organisation that doesn't yet use us for accounting services and has come to us for a piece of work and advice from me specific to their needs.
Thank you so much, Cecile. That's really, really helpful. We're just going to take a few minutes for some questions now. There's a few in the chat, which we'll seek to get through as many as possible. And actually, Cecile, first one for you. There's a few questions on CIOs and CICs. Where's a good place to go and find a helpful summary of the CIO rules?
There is, I'm afraid, no single place, and be careful about that, because the Charity Commission published material is really directed very narrowly to its regulatory function, how you would apply to set one up, what the mechanics are. And one of the points, for example, that they've tried to make clearer is the point I made about the accounting requirements being different for CIOs. So there is no single source. A conversation with people like us will help on general areas or specifics. And there are some publications like the Chartered Governance Institute's How to Run a Charity has some relevant material in it. And indeed, a new edition of that will be issued this year.
Thank you. And a very interesting related question. It's CIO. Can a CIO be wholly owned by a PLC?
No charity can be owned by anybody, whatever its legal form. So firstly, no charity would normally have a single member. There's a few exceptions to that, but generally speaking, in a membership charity, the absolute minimum, even to establish it, would be 3 members. So you're unlikely to have a single member except in rare circumstances. A PLC couldn't be the sole member because a PLC exists for commercial benefit to a very significant degree if it's a major PLC, although there are lots of tiny ones as well. So no, a company can potentially be a member of a charity, but only for philanthropic purposes to support its activities, its charitable activities. There isn't a concept of ownership and ownership benefit from any charity.
Thank you. And a CIC on winding up, can it transfer its assets to a civil parish council? That's quite a specific question, I think, about a particular case, but.
Okay, so here we're talking about community interest company. The answer is absolutely not, because a civil parish council would not fit the CIC law definition of an asset locked body. Remember, you can only transfer to one of those, which must either be one listed in your constitution, and it has to be within that definition, or if there's not one listed in your constitution, an asset locked body that the CIC regulator approves. Essentially, they're going to be registered charities or other forms of charity. The charities that are not on the register but are bona fide charities, or other CICs. And there's one further type, which is a registered society. But no, absolutely not a parish council.
Thank you. Jonathan, lots of appreciation for your input in our session today. Richard asks, what do you believe are the biggest challenges for charities in bouncing back after such an unprecedented year? And what support do you think that charity teams now need as we emerge into the new normal?
Thank you, Ed. That's a really helpful question, and I've been sort of thinking about it whilst we've been listening. I think there's 2 points really. One is, don't assume that you can go back and do what you were doing pre-pandemic. The world has changed around us, and I know for not all charities have been able to continue operating in the way that they have been in the past. So what's needed now, I think, has to be the question, but keeping a very close eye on those charitable objects. What are you there to do? What are you set up to do? And what is your funding there to enable you to do? And I think following on from that, many of us rely on volunteers. So even ourselves, we're having to rebuild that team of volunteers who enable us to operate. Support, I think it'd be great to see a lot more support across between charities. There's a big piece of work going on across Bristol at the moment, looking at rebuilding the voluntary sector, led by Bristol Network. They've done a lot of thinking about rebuilding resilience across the voluntary sector, connecting in with that and getting mutual support.
Fantastic. Thank you so much. We promised to. Sorry, Josh, do you want to?
I've got one more to squeak in if we can. Is that yeah? So a question that might be arising for a few trusts, and I've got one here who's thinking about either a charitable company or a CIO. Is there any sort of quick pros and cons, and perhaps we'll have a specific conversation with them afterwards as well?
It's a very nuanced set of answers and very situation specific. Couple of key things: if you're already a charitable company, do not contemplate changing. It would be entirely unsuitable. If you're a new startup, there's a debate to be had, but still, by and large, it may well come down to charitable companies. Very situation specific. You must take advice on your situation.
Thank you. We promised to finish on time, so we will do that. But I just want to say a special thank you to Jonathan for contributing today. Thank you also to my colleagues Cecile and Josh, and thank you everybody else for being with us. We're really delighted you've been able to be here. We would very much welcome further contact with you. We'll be sending a mailing out after this event, and do feel free to get in touch. And if there's anything that you feel like you'd appreciate more input on or help with, we would be really delighted to help. We're planning on running these events regularly. We haven't got a date for the next one yet, but we're looking around about every other month. So we would love to see you as regulars along to these events, and we hope that you find them very helpful. But meanwhile, have a great rest of the day, and hopefully we'll get to see you soon. Thanks. Bye for now.